Good morning, and thanks for having me back again, and special thanks, congratulations to Kyle and Jeff. The seeds that you guys planted over a decade ago and have nurtured have become extremely meaningful for our community and our kids, so thank you for that. Just briefly on what we do, to put the recommendation in context, because it certainly is in context. As mentioned, we're focused exclusively on publicly traded real estate securities. We operate long and short, so our strategy is not reliant on being bulls for real estate. We seek to outperform irrespective of real estate supply and demand fundamentals or valuations. We seek where relevant and appropriate to be active, value-add strategic investors. We don't seek to be hostile, to borrow the words of Prime Minister Harper. We seek to be constructive activists. It takes you 30 years to build relationships. You can damage them in one day. As a result, our funds have benefited from 22 takeovers in our portfolio holdings in the last 17 years at an average takeover premium of 28%. We focus primarily on North America, but the core of what we do is to focus on the combination of top-down and bottom-up. Top-down for supply and demand, macro conditions, regional economic trends, employment growth, and then bottom-up, management teams, lease structure, corporate governance, to establish our view of the underlying net asset value of the real estate. What is that real estate worth in the property market, and then compare it to what it's trading at on an applied basis in the stock market. The advantages of what we do, relative to what I used to do, or some of the former panel members, is by definition, you can't buy real estate cheaper in the property market than the property market, and we can. We have professional management, we have corporate governance, we have transparency, we get geographic diversification, we get property type diversification, we get access to the highest quality properties that may not be available at all in the property market, and we have liquidity. And well, liquidity is or should always be a paramount consideration. It's years like March 2020 or 2022, where Brexit came to the forefront, or October 2025, where liquidity takes on a different dimension. You know the names, I won't mention them, but scores and scores of private real estate funds that have gated their investors in terms of restrictions. Anytime you have that mismatch between the underlying liquidity of what you're investing in and the liquidity you promise your investors, those are accidents waiting to happen. And of course, if the fundamentals are negative, or valuations are too high, you can't do anything about that in the property market. We can by being short. And the difference between real estate and any other asset class is the size of the private property market dwarfs the size of the publicly traded universe. It's a $2 trillion universe, but there's an arbitrage between the two. Returns have been solid, mentioned earlier, about 10% CAGR, compares well to Canadian US REITs, private property markets, global and Canadian hedge fund indices. And the most important thing about Vision is not the absolute returns. They're quite solid. The most important thing is the risk-adjusted returns, things like over 3 to 1 up market to down market capture ratios. Low correlation to REITs, low correlation to private real estate. And we've been operating 17 years. 16 of 17 were positive. In the one negative year in 2022, we beat the index by 1,000 basis points. Frankly, I translate to one thing: don't lose money. If you don't lose capital over the longer term, you'll probably do pretty well. So this conference was really a setup for this recommendation. We're going to give you a very actionable idea to put to work a lot of the themes we've heard. Data centers at a deep discount. Why data centers? But just unpack some of the discussion. 3 major components to the market: the carrier hotels, wholesale and hyperscale facilities. Carrier hotels, smaller leases, less than 250 kilowatts, focused on connectivity, large number of tenants. The wholesale, medium-sized, 250 kilowatts to 8 megawatts, shared between large tenants. And the hyperscalers, larger facilities, 10 to 300 megawatts, typically cloud or AI operations, often single tenant. So 3 main types of properties. Demand, you've heard it for 2 days, voracious. Global new leasing volume in 2024 was 5.7 times the level 3 years ago and 15 times the level pre-COVID. It's not about AI. AI could be zero, and we think AI is really real. We use it in our business. But you're seeing explosive growth in networking and hybrid and multi-cloud, like 40, 50% growth without any AI. You're seeing $20 billion growth in networking, $30 billion of growth over the next 4 years in both cases of hybrid and multi-cloud. So AI, we think it's real, it's explosive, it's just adding to this demand. And so if you think it's hype, it doesn't really matter to the explosion of data centers. I mean, look at hyperscaler capital expenditures. For 2025, they increased by over $40 billion, representing a growth rate of 50% year over year. And Alphabet, Meta, Microsoft have already signaled that 2026 capital expenditures will be even higher. Putting this demand together, you're seeing over the next 4 years, 79% growth. The global data center market is expected to double by 2028. Power, everybody understands, anybody who knows anything about data centers knows the key gating factor is access to a lot of reliable, redundant power. Artificial intelligence requires 3 times more power than traditional high-density racks and 10 times more power than traditional retail racks, key gating factor. And yet data centers typically require large power loads that only the biggest 500 plus kilovolt transmission lines can carry. The problem is, our energy grids were originally built to serve lower power loads, and less than 20% of transmission lines are capable of carrying 500 plus kilovolts. So no surprise, vacancy rates have fallen significantly. This is what we love at Vision. We're focused on supply and demand. We call it our blood, near frictional levels at 3%. We're going to talk to you about an actionable way with high yield, deep discount to participate in this opportunity. And our recommendation is Digital Core REIT. This is off the radar screen. It's listed in the Singapore Stock Exchange, and we'll unpack that for you. $1.7 billion enterprise value, sponsored by the global leader Digital Realty. They have a portfolio. Well, they're listed in Singapore. Their properties, 11 of them, are in global markets: Osaka, Frankfurt, Silicon Valley, Northern Virginia, Toronto, and Los Angeles. They have access to a $15 billion acquisition pipeline, 81% investment-grade credit. Tenants. It has a 7.5% distribution yield, very tax effective because there's no tax on dividends or no withholding tax on dividends coming from Singapore, and trading at a 40% discount to its net asset value. So we believe Digital Core is one of the highest data center portfolios globally in trading at the highest discount to net asset value amongst its peers. I talked about these 6 major markets. These are the best markets in the world. I mean, you're talking about Northern Virginia, which is the most important and largest data center market in the world because of its location next to the cable network under the ocean. And Frankfurt, Northern Virginia and Frankfurt, I talked about 3% market vacancy rates in the market. 60% of the value in Digital Core in these markets have less than 1% vacancy rate. Why Singapore? Singapore investors don't pay tax and distributions, so it's a logical place to list stable cash flow generating real estate. It's a big market, close to $1 trillion of market cap in this market. As a result, and this is coming to the opportunity, why is this opportunity there, is the structure and stability of the dividend is the omnipresent focus for Singapore-based investors. And Digital Core was forced to reduce their distribution slightly due to some events that we're going to unpack for you today. So we believe this myopic focus on short-term cash flow and distribution is giving rise to an opportunity to profit from the dislocation between the stock price and its net asset value. So the first issue was, at the time of the IPO, Digital Core had debt that consisted of a single term loan of $350 million. It was 100% floating rate. So we know what happened in 2022. That was a concern. So they got ahead of this curve. By the end of the third quarter, it was 50% hedged by the end of the third quarter, and 75% hedged by the end of fourth quarter. Today, 85% of Digital Core's debt is fixed rate minimizing volatility in the distribution. Then the market was concerned about their second largest tenant, Cyxtera. We'll unpack that for you. Cyxtera did go bankrupt in June 2023. And future increases to distributable income will come from releasing the Cyxtera, as well as a releasing of the REIT's Linton Hall property in Northern Virginia, where its lease expired on its tenant in June 30th of this year. So let's talk about Cyxtera. Second largest tenant, represent 22% of the total rent across 6 properties. Now, while Cyxtera was financially challenged, the properties where they were located were not. The resolution of this so far is 1 lease was assumed with no impact to rent, 3 leases were amended, we'll come back to that, and 2 of the assets were sold to Brookfield at their book value based on a 4.4% cap rate. For the leases that had a near-term termination, the digital REIT had initially 50% cut to the rent, but this is an opportunity. The 2 Los Angeles properties, the REIT is investing $10 to $20 million, which is already proven to be highly successful, a $4 million increase in annual cash flow. And specifically, for example, the repositioning of Los Angeles resulted in a 175% increase in rent versus its in-place rent, which equates to an unlevered return on capital spent of 27%. Then more recently, this year, the tenant at their Linton Hall property did not renew. Digital Core intends to spend $20 to $40 million to complete a 12 to 15-month renovation upgrade. This is an opportunity. This will come to be leased probably, in our view, middle of 2026, because these guys are very short-term focused with the demand. So in sectors where you have compelling supply and demand fundamentals, lease expires represent opportunity. Moreover, this property specifically has 32 acres of developable land, which can support the development of a second facility and double this property's sellable capacity. So Digital Realty Trust, for those of you who aren't familiar with it, is the 5th largest U.S. REIT. It's the largest unit holder with a 32% stake. They have a 10% direct stake in the properties, and they're managing this at market fees, 50 basis points of asset value, 3.5% of net property income. So extremely aligned, extremely supportive, extremely value add. So specifically, Digital Core benefited from Digital Realty helping them get into the Asia Pacific region. Digital Realty helped them resolve that Cyxtera lease. Digital Realty provided a 5-year interest-free loan to the REIT, and they contributed a 15% interest in a Frankfurt data center to the REIT at an 18% discount to appraised value. They benefit from all this. They benefit from Digital Realty's operational expertise, broad and deep market knowledge, and industry-leading global relationships at no incremental cost. Digital Realty is highly motivated to have this work. This is their reputation. And so they're highly supportive as the manager. Valuation. This stock is silly cheap. You see the comparables both in Singapore as well as the large caps that you probably might be familiar with, Digital Realty itself and Equinix. In Singapore, the REITs in this space are trading an average 35% premium to net asset value, an average yield of 5.1%. As mentioned, Digital Core offering a 7.5% dividend yield, tax effective, 40% discount to net asset value. And they own 100% of their properties. They're the only REIT listed in Singapore that can boast that. Others have leased properties as part of their portfolio. So it owns one of the highest quality portfolios, trading at the widest discount to net asset value. You can see this graphically here. Balance sheet is solid. 100% unsecured debt, 3.4% average interest rate, 85% hedged. They recently entered a $750 million medium-term note Multi-currency, so for example, and specifically, this enabled them to recently put on a Japanese yen to match assets with liabilities, a facility, 5 years, 1.97%. So currency hedging, cheap debt, and lots of liquidity to pursue their current plan. And it's not just about NAV today. It's just not about that 78 cents. We see NAV increasing. The Linton Hall releasing is going to be incremental to that. The stabilization of the existing tenant base and the mark-to-market opportunity from releasing their existing tenants as they come to maturity. So this discount to NAV has the potential to go from 40% to 50%. We've seen this movie before. As Amber kindly introduced, I've been here 5-6 times. And as I said at the outset, that difference between real estate and any other asset class is that arbitrage between the private market and the publicly traded universe. Frankly, we say we'd rather not compete with Blackstone. They do a very good job of what they do. We'd rather sell to Blackstone. And so we've had 3 of the recommendations, for example, of those 22, 3 took place at this conference where they were takeovers. And that's the difference between this space and any other space. And then you have the impact from its sponsor, Digital Realty, being there. If it doesn't work, this will not go on forever. So just what do we got here? We have an actionable idea, recommendation in one of the most highly sought after asset classes globally. We've been hearing about this for 2 days at this conference. It's the only data center REIT available at a discount to NAV, strong outlook for earnings and net asset value growth. We've seen a long history in this sector of company privatizations. It is the highest demand profile of all REIT sectors globally. It is obvious that supply will not be able to keep up, primarily due to power constraints. And it's not just power, it's equipment and it's labor adding to this mix. A tax-efficient, compelling yield, and we see multiple catalysts to surface near-term value. Thank you for the opportunity to present to you today, and enjoy the rest of the conference.